Hello everyone, welcome. A technical webinar this time, double Bollinger Bands. I was watching earlier another webinar with the 00 strategy. I got a bit confused. So, we are ready to start. I'm gonna go through as usual the admin disclaimer warning. So, I can see that people still joining. Okay, perfect. Okay, so this material provides a general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk, for which the users are so responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. All our legal documentation, guys, is on the website, so feel free to have a look. If you wish to read the full risk disclosures over there, along with anything you want to see. So I would like to welcome you once again in this session. As we already mentioned, we're gonna go through double Bollinger Band strategy. My bad. Anything you need, I'm here to help. Remember that for any questions not related necessarily with this session, but in general, any questions that you have for fundamentals, strategies, setup, anything that you're struggling with as a trader, please send us an email at webinars@hfm.com. Okay, it will be analyst team that is handling this email, so feel free to ask anything you want. As usual, this webinar has been recorded, so don't worry if you cannot stay until the very end of this session. The team will send you the recording later on. Usually we are trying to provide them by Wednesday afternoon or Thursday morning, okay? So you could get both webinars for the week, mine and Michali's. Yeah, so I remind you that this session is being recorded, okay? Anything you need, stick it on the question box, and I will be more than glad to answer. So, okay, trading with double Bollingers. So it's a Kathleen Lean strategy, by the way, that I'm gonna go through today. She's one of my favorite, actually, traders, economists, analysts. I like how simple she explains everything and how simple her strategies are. So we're gonna go through the single and double Bollinger Bands, the rules that these strategies are based on, okay? Obviously, some examples, how to pick the tops and the bottoms, how it can help you. I mean, using double Bollingers, how it can help you to in your daily trading, basically to spot a trend, to spot a range, and how you can use them to trade a trend or trade even a ranging market, or even how to spot an entry level. Okay, a trigger point, how to spot the trigger point that could lead to an entry point later on. So any questions are more than welcome, as we keep saying. So let's move on. Okay. Oops. Yeah. Perfect. Okay. So first of all, a bit of an intro, let's say, okay, before we jump into Bollinger's, because Bollinger's is a technical indicator that sorry, let me just get rid of this. Okay, perfect. So because the Bollinger Bands is an indicator that helps identify a trend. Basically, it primarily is used for trend analysis. Okay, that's why it's very, very useful for identifying entry and exit points with precision, we could say. Okay, let's explain firstly, since a trend analysis, the meaning of a trend analysis, and also obviously the meaning of price action. Why, how the market, what is a price action? What we call the price action, first of all, and also how you can read a price action. Okay, what you can conclude by monitoring the price action. So price action, what we call price action, is basically purely the movement of the asset. Okay, you know, let's say gold, for example. Price changes over time, right? So these changes that we are seeing in the price is what is called price action, is the movement of any asset. I mentioned gold because it's the oldest asset in the world, tradable asset in the world. So it basically is the movement that we are seeing, the price movement that we are seeing for any asset over time. This is what is called price action. Price action, okay, this change in the price over time is the basis, is the stepping stone for all, absolutely all technical analysis, even if we are referring to stocks, commodities, energies, shares, ETFs, cryptos, everything, okay? Price action forms the basis of all technical analysis. Any basically, as you already understood, I guess, is the movement, the movement, right, that we have seen is because of the buyers and sellers that there are in the market, right? How many people are selling, how many people are buying, the so-called bulls and bears, okay, demand and supply. So by trying to read, trying to understand the price action, that helps us to place any trades based purely on the price movement observation, right? That's why there are a lot of people out there that they are price action traders. They don't use any indicators, they use price action. So they just checking the charts, just checking the candlesticks, okay? So observing the movement, nothing else. This is their technical analysis. Okay, so price action strategy. Basically, if you are, I don't know how many of you are price action traders, but the only thing that you need, as I mentioned over here, is to spot, to put down, to write down, to put a note on support, resistance levels, observe very carefully the body of the candles, the tails of the candles, okay, and also spotting any patterns, okay. So it is challenging, right? It is challenging, but it's as simple as that. Challenging and simple. I know that they are two very contradictory terms, but there is a lot of beauty in this simplicity. Okay, that's why a lot of people prefer that. But because as human beings we are a bit insecure, we want indicators to help us getting more confidence on our decision. Okay, to give us a bit of a yeah, confidence. Basically, this is it. So, okay, let's jump into the Bollingers. Okay, as I mentioned, is a technical indicator. Okay, which is based on the price action of the asset. Okay, and provides basically a band of support and resistance levels using standard deviation. Okay, so it's a chart indicator, so that's why it's applied. I don't know how many of you are using Bollingers, but this is how it looks like. It's just it's on the actual chart, not beneath that, and basically determines market volatility over time. Okay, and the concept, the mathematical concept, let's say, behind it is standard deviation. Okay, so basically you can think it as a volatility channel. It is a volatility channel. So we have three lines plotted on the price action. These lines represent support and resistance level and the average price in the mid. And basically these lines, basically it is called volatility channel as well, or is known as a volatility channel as well, because these bands, these lines, they're not just, okay, I mentioned it is standard deviation. It is with the use of standard deviation from the average price, we're getting these bands, but these bands basically present how volatile or not volatile a market is. The wider they get, the more volatile the asset is. The narrower they get, the less volatile the market is. Okay, so Bollinger's measures market volatility. Okay, that's why it's quite useful for spotting, for confirming a trend, if you wish, for identifying whether the trend will continue in the same direction or is about to reverse, to identify a period of market consolidation, a period of upcoming volatility, large volatility. And the tops and the bottoms of the Bollingers could be useful for entry levels, targets, exit levels, potential price targets, etc. Okay, so it's a simple moving average using two standard deviation. With this way, we have these three lines indicator with the let's see, oh, sorry, by the way, is highly popular for trending market, not so much for a ranging market, but mainly for a trending market. So this is what I was talking about. The upper, basically let's start with the center line. The center line, guys, is the sorry. The center line is a simple moving average of the price, okay? And the upper and the lower line are created using the standard deviation. So the upper band line represents a level that is statistically high or expensive, let's say, while the lower band represents a level that is statistically lower or cheaper. So remember the width of the Bollingers also matter. So the wider it gets, like here, for example, that indicates that the volatility is increasing and increasing for that particular asset. The narrow here suggests consolidation, suggests less volatile market. Okay. So let's move on. Okay. Very, very briefly, some cons and pros of Bollingers. So, first of all, one of the benefits of using, actually this is vice versa, but nonetheless, one of the benefits of using Bollingers is the fact that it spots volatility. It's an oscillator, okay? It's an oscillator. Presents where the price is in regards to the recent history. It gives you signs of high risk, right? It helps you obviously to identify the direction of the trend and also the momentum and the market energy of the trend. And it's quite simple and easy to understand, I believe. However, some of the disadvantages, okay, is that is not working for a ranging market. You can spot a ranging market with Bollingers. You cannot use it for trading a ranging market, okay? So it works on a trending market. Also, it provides trigger points, it provides potential entry points, but not absolute, okay? So it's better to cross-check it with another indicator or just your price action analysis. So it needs to be combined. This is what I'm trying to say. Now. Okay, by default, okay, the Bollingers is set at 20.2, okay? So 20 is the value of the simple moving average, and 2 is the standard deviation that is used. Occasionally, or for us, some assets or for some time frames, you will have to change the standard deviation or the value of the simple moving average, but that's not so common, at least for the asset that I'm using it for. So, but it depends, because I don't know what traders you are. I mean, obviously, if you're gonna use it for a 15-minute chart, it needs some adjustments. We have already covered that, but just to state something that is very, very important over here, guys. The higher the standard deviation, okay, so if you put a really high standard deviation, okay, that will give you wider Bollingers, Okay, so you need to choose your settings wisely. You need to choose your settings to make sure basically that it's not way far away from the price action, but not very, very tight. What I mean, let me just actually let me show you. Come on. You need to make sure that the price action is compressed within the Bollinger, not out. So you shouldn't leave the majority of the candles outside the Bollingers, because this won't be useful. So indicators, where is our Bollinger? Here we go, Bollingers. Here we are. Perfect. You see? So if I zoom out a bit, I'm gonna see that okay, that's quite nice. I have some situation in which the price is outside, but that's because it was oversold or overbought. It looked just fine. Okay, but if you change the settings, okay, and you could put it too far away, you see? So unrealistic support levels, unrealistic resistance level. Let me get rid of the moving average so you won't get confused. You see, far away, the upper and lower Bollingers are are far away from the actual price action, so they don't help you identifying nice support and resistance level, okay? Or any reversal, basically. So two, in this case, two standard deviation, it looked just fine because it helped us. You see how nice support resistance that was, how nice support this was. The breakout trigger attention lower, right? Oversold over here, so need of a correction before another attempt on the downside, right? The middle line in this case is very useful as an entry point, because any breakout below the middle line is calling for a sell position. Any breakout of the middle line but above the middle line is calling for a possible buying position, right? So that's just fine. If you tight it, I mean, you put really, really tight, sorry, then again, it gives you some nonsense, excuse me, but you see, the price is always outside, not useful at all. So you need to make sure that the settings that you're gonna use are appropriate for the asset and the parameters that you have and the time frame that you're using, okay? So the tighter the parameters, or if they are way too high, that could lead to some false signals. Now, we already covered the high volatility, low volatility, and I think just a bit of a reminder, okay, before we see the 00, okay, I mentioned that the wider the Bollinger are, the higher that indicates high volatility, okay? So that if you are in a downtrend, that indicates further decline. If you're in an uptrend, that indicates a further rise, or it could have driven by a sharp rise. If you notice that the price is outside Bollingers, that indicates overbought or oversold condition, that they might need a bit of a correction or a reversal. Now the narrow, so if they are very close to each other, that's low volatility. It's not wise to trade it. It's sideways. It's just bouncing within a particular range for a while. So it's consolidation. Now, remember that upper line, right, acts as a resistance line, okay? But also, so acts as a resistance line. So if we see a reversal, let me zoom in a bit, because exactly it's, sorry, cannot zoom in. No, I can't. So hopefully you can see this one. So retest, actually it has been retesting the upper line for a while. So this is, so if it reach the upper line, that's a bullish sign, okay? But you need to be careful, okay? Consecutive higher highs close to the resistance, that indicates strength indeed, of course, if are consistent with other technical tools. So that suggests, as you can see, that there is a trend. There is the upper Bollinger line is expanding and pointing higher. Okay, so that suggests that it will remain to the upside. So that's a bullish sign. But a reversal away, okay, from the resistance line, from the upper line, like here. I'm not saying here or here because this was a solo one, just once off. Here, however, we had a doji one, bearish, and a second bearish one. So that indicated a reversal. So this is a selling signal, okay? Because it suggests weakness, suggests a reversal away from the upper Bollinger Band level. The same stands for the lower line. It could indicate a continuation of the move lower if it's also consistent with other technical tools, or if we see consecutive bearish candles, lower lows, and Bollinger Band line extending lower. You see, extending lower. Let's put the, so let me find a different example. Come on, I want the Bollinger Band over here. Bollingers. Oops, that's quite tight. What have I done? Oh, my bad, sorry. Okay, so you see, okay, now it's squeezed again. I want to find narrow. I want to find an example at which you can, come on. Okay, look at that. This is Euro pound Swiss 1 hour chart. Can you see that hopefully you can. Let me get rid of some of the okay. I had high Kenashis. That's what I wanted to get. So I want the candles. Perfect. Okay. You see, it's pointing higher, right? Pointing higher. The asset is on the, actually it's outside the Bollinger Band line, but the Bollinger Band line expands higher. So that suggests the possible continuation of these four sessions move higher. Okay, so we need a confirmation, maybe another indicator to to confirm whether it will continue on the upside, or just wait for this candle to close and see whether it will be positive close or whether the following one will have a higher high and a higher low, suggesting the continuation of the trend. So the same sense for the downside, right? Down, broken outside Bollingers, okay? So full body, nearly full body candle, indicating a lot of selling pressure. So this is an indication of a strong continuation of the trend. But look at the Bollingers. It's sharply down, sharply pointing lower. So that's a selling signal, and that looks to be, for the time being, a bullish signal. Nonetheless, let's continue. Now, double Bollingers, right? Double Bollingers. Okay. Remember that as we already covered for 29 minutes now, the bands, right? The bands, the upper line, the lower line, is the ones that should be of interest to us, right? So, as we explained earlier, trading near the outer bands, so basically the upper line, the lower line, it provides some clues, okay, regarding a bullish, bearish momentum, and also it's an element of confidence that there is a resistance and the support level, okay. But as I mentioned earlier, it cannot this alone, let's say, does not provide an accurate buy and sell signal. So either you're going to combine it with price action analysis or with another indicator. So now, double Bollinger, basically as double Bollinger Band strategy, as you understand, is a Bollinger Band strategy that has two different Bollinger Bands. Hi, there are bands normally used. Did not know they were called doubles. Which ones are single ones? No, it's just twice. Oh, you mean in your MT5 you have a double one by default, you mean? Or we call double Bollingers when we apply twice the Bollinger Bands, but with different settings. But I'm not sure whether the MT5 has a double Bollingers by default. I mean, an actual indicator that adds automatically two Bollingers. No, I don't think so. I haven't seen it, at least I haven't noticed it. No. We have triple exponential moving average. We have double exponential moving average. No, but no double Bollingers. So basically, dear Rodero, double Bollingers is when we apply twice the Bollingers. So I have it once, okay? I'm gonna apply one once again, but using different settings, changing the settings, okay? And just putting it randomly so you could see double Bollingers, okay? Twice with different settings. Now, this strategy is, as I said, is popularized by Kathy Lien. I don't know how many of you know her, but she's brilliant. Yeah, there's nothing that if you Google her, you will see. So yeah, she's a very, very well-known Forex analyst and trader. If I'm not mistaken, she started working in Wall Street 19 years old. So he graduated university much earlier than the average people, actually, than the majority of the people. So, okay, you understand how brilliant she is. So yeah, it's a strategy that it was popularized by her, 00 strategy. So that's why there are certain rules, okay, for this strategy. So basically, it's as simple as that. I mean, I told you it's a double Bollinger Band strategy. Twice we're using two Bollinger Bands, but with different settings. Okay, it's very simple. It can be used for any actively traded asset. Okay, preferable for liquid markets. Okay, not in liquid markets such as forex, stocks, and commodities. Okay. So how you apply it? As I told you earlier, you drag and drop twice the Bollingers, but you change the settings. So, okay, I'm gonna show it again. Remember, our navigator is on the left-hand side. Just drag and drop. That's pretty much it. Okay, so yeah. So for that particular strategy, we keep the default setting, which is 20 and 2. Okay, we keep the default 20 and 2. I'm going to put it in black, I think, just to make it a bit so you could see it. Okay, and for the second Bollinger, which I have in green, we're gonna use one standard deviation. I have already said it, okay, in green. So two standard deviations. So very easy, drag and drop. One default Bollinger with a 20 and 2 standard deviation, and the second one 20 and 1 standard deviation. Okay, so you have, as you can see, 5 lines, right? 2 upper ones, 2 bottom ones, and 1 in the middle, which is the average. So that if you think about it, let me zoom in a bit. These are 3 zones. Have you noticed? 1, 2, which is the big one, 3, or okay, you can call this a 4 zone. 1, 2, 3, 4. Okay. Okay. Now, according to this strategy, okay. Do I have it plotted in a chart? Okay, later on. Okay. So we have 5 lines, 3 zones. So if, okay, I know that this should be on an actual chart, so you can, I will put it side by side to be easier for you as well. So let me just get rid of it. Okay. Now, if the price, okay, guys, remains above the upper 1 standard deviation, but below the second standard deviation, so that means, let me zoom in a bit. Okay, for example, if the price remains above this first standard deviation, so this one, the first gray one, but below the second standard, the 2 standard deviation, that is suggesting long positions. If it holds in this range over here, so between the 2 upper lines, that is a suggesting, can I go backwards? Okay. So that indicates further buying pressure that suggests long positions preferred. Can you see that? Here we are. It stayed within this range, sometimes outside because it was overbought, but it stayed, and you see, it moved higher and higher and higher. This is because if the price remains within these 2 lines, is a long position preferred. Now, if it remains a bit between the 2 lower lines, like here, you see, so first indication that is the short positions preferred is the fact that is moving within these 2 lines. Second, both Bollingers pointing lower, both lower lines pointing lower. Third indication, 2 massively and quite big bearish candles. Overbought a bit indeed, but you see the candles over here are a bit small, suggesting that there is just a correction before another attempt to the downside. So there were plenty of clues to suggest, there are plenty of signals to indicate that this is a short, this is a sell, these are sell signals. Now, if the price remains under upper standard deviation, one standard deviation, okay, and above the lower standard deviation, so within the second Bollinger Band, okay, that's neutral, that's consolidation. Have you seen that? And this is actually here as well, you can see it here as well. So if the price is within the body of the standard deviation that within the one standard deviation that we used, that suggests a neutral outlook, sideways outlook, consolidation, ranging market. So if you have, how you can use that, if you have already a trending position, I mean, if you had a long position or a short position, you might consider closing it as soon as you see the asset stuck within the one standard deviation range, or you might look for any breakouts or any oscillating trades. Now, some of her rules for basically instructions for applying this strategy. Okay, we explained the buying zone that is between the two upper Bollinger Bands. We explained the sell zone, which is between the two lower Bollinger Bands. Okay, we explained the neutral zone, which is suggesting a consolidation. Okay, now let's see some of her rules in order to apply appropriately the double zero. Oh my God, what's going on with the double zero today? The double Bollinger Band strategy. You will first wait for entering the market, either short or long. Okay, you will wait for a break into the neutral zone. Okay, so I'm gonna get back to the chart over here so you can see, you can follow me. Okay, so trade long, take a long position. Okay, if the price breaks and candle closes above lower standard deviation. So lower standard deviation is this one, right? You can see my cursor, right? Oops. Can you see it? Hopefully you do. This, the lower green line, okay? If the price breaks and closes above this line, so basically enters the area, the one standard deviation Bollinger Band, but from below, that suggests a long position. Okay, okay, so with stop loss now, two candles below, so 1, 2, so stop loss is here. I'm gonna put it on so you can see it. Stop loss is here. I'm gonna put it in dark blue. Okay, stop loss is here. Two candles below. Target. Okay, you can choose 50% of your position. So if we saw the break over here, let's measure it. It's 50 points, 100 points. So that means our target will be somewhere here. Oh, wait a minute. Let me just strengthen it a bit. Okay. Target 1 multiplied by stop loss level, choose 50% of your position. Okay, so 50 points is somewhere here. Somewhere here. So that was the entry. let's put, oh, wrong entry, sorry. Entry was here. So let's put the entry with green, let's say, or gold, okay. Okay, and target with, I don't know. Actually, let's keep it blue, and stop loss should be with red. Okay. And you can put a second target as well, twice the distance from the, let me measure it, let me be precise. It's quite higher. Come on. It's a bit higher. Measure it again. Okay, nearby. Okay. Now, you need to move, however, the stop loss to the entry point, okay? As the price moves higher, okay, you should move. So let's say if he hit the first target, you should turn the stop loss. You should put the stop loss to the entry in order to lock some gains or break even, okay? And close the remaining 50% of the position at the second initial stop loss. Is this clear or not yet? So let's see an example. That's the zones. It's the zones again. Come on, come on, come on. Okay, let's assume, okay. Actually, I'm gonna keep it live like here. So in this, actually for simplicity, you can use trailing stop losses, by the way, okay, by setting your stop loss, let's say, since we measure that is, we should place the stop loss 2 candles below. So let's measure the entry from the 2 candles below is at 48, okay, 48 pips, okay. So you can put a trailing stop loss 48 pips below the entry point. So as it moves higher, it will move along with the trend, locking profits and moving higher and higher and higher and higher, and it will stop basically somewhere here, because as you can see, it stopped moving higher. So it'll be somewhere here, sorry. So it stop moving higher, so it will close somewhere here. So we will be on profit with this distance over here, locking some profits as well. So you can use, for your stop loss, you can use trailing stop loss. Just make sure that by hitting the first target, that will be the close of the 50% of your position. So, or if you want to use more than 2 targets, please make sure that you have not left the big portion of your position open. It's wise to use, let's say, 40, 40, 20%, or 50, 30, 20%, and so on and so forth. For a short position, it's the same exact mentality, the same exact rules. So if you see the price breaking, so let me get rid of these lines. I will put them just lower. So if you see, you're gonna take a short position as soon as you see the price breaking and closing below the higher 1 standard deviation. So look at that. It was higher, okay? It started consolidating over here, move lower, and it closed exactly on the first standard deviation, the higher standard deviation. The next session, however, is stayed and stayed and stayed for 3 sessions in a row on the Bollinger. And then here was a confirmation. It finally confirmed a closure below the first standard deviation. So this is calling for short position. The target, the stop loss in this level, again, it should be 2 candles above. So that should be here. Don't be afraid to put it a bit higher, just a breath above the high. That's more wise. Target by the stop loss should close 50% of your position. So the entry was here, right? Target should have been, let me measure it, so around 15 pips. Should be somewhere here, if I'm not mistaken. Either use a stop loss in order as your asset is moving lower to your closer to your target, or move stop loss to entry in order to lock some profits or break even in case if it turns against you. Close remaining 50% of the position at twice the initial stop loss, okay, or 3 times the initial stop loss. So that should be somewhere here. So let's say target 1, target 2, and so on and so forth. Okay, guys, if you don't want, if you don't like this approach, I mean like the target approach, it's fine to apply your own target, I mean strategy, but make sure that you keep the stop loss 2 candles above or 2 candles below if it's for a short or long position, okay? And try to keep your targets at the logical levels. I mean, use, let's say, ATR, twice the ATR, or use, let's say, a tool, I don't know, Fibonacci extension, for example. You can use it. Here we are. You can place target at this Fibonacci extension, target 1, target 2 here, and this is it. Or, I mean, it's okay to apply your way of finding targets, but as long as your risk management, you have done your risk management, right? So let's move on. Yeah, so what else? So we have spoke about the zones. Excellent. By the way, something that I forgot to mention is that we haven't discussed anything about break of the middle line, okay? Break of the middle line could be useful for adding to your existing position. So remember that we said that you can consider taking a short position as soon as the asset breaks and closes below the upper 1 standard deviation line, correct? So here, let's say, here. Now, if you see a break of the middle line lower, okay, that suggests further decline, so you could add on your existing position, okay? Or, by the way, something that I forgot to mention, you can use the Bollingers as your potential targets. So, for example, sorry, my bad. Or the previous highs as your possible target levels in the previous lows. Or, for example, right now, if we see reversal, okay, we see reversal. Let's assume, basically, let me take an example. Okay, so here we are, okay, here. We had a pullback, right? And a consecutive negative candle, right? So you can use the lower Bollinger Band lines as your immediate target levels, but this would be just the immediate ones that for very, very small positions. But let's get back. So another thing that I wanted. Yeah, so you can use the break of the middle line just to add on your existing position, because the break below the middle line suggests that yes, there won't be any reversal. Yes, this is a strong downtrend, that it could continue further to the downside for a while. Okay, while exiting your position, let's assume that you have taken this entry, right? You can consider exiting a position as soon as you see a rebound, and more precisely, a move above the lower one standard deviation line. If and only if your target and your position is still open, obviously, right? So I have the rules for how to close your position. So I have split the Bollingers into zone. Okay, I named the top one A1, the second one B1, B2, and A2. C is just the center line. So, as we mentioned, for opening a long position, for example, okay, you can open, let's say, a long position when the price is within the upper zone, so basically A1 and B1, okay? And if we keep seeing higher candles and higher candles, so that means we have a strong uptrend and a high probability of continuing this uptrend. So like that, this is a very, very crystal clear example. Is within the A1 and B1, actually it's above B1 and is within A1 and continues being within A1, posting higher highs, higher lows. So that's just a strong, strong trend. Sell zone is this one, the area between the A2 and B2. So consecutive candles within this area pointing lower and lower and lower and lower, moving lower and lower. It suggests a strong downtrend, so it will continue lower. So you might try to apply your Fibonacci's or your risk and reward ratio to spot some potential target levels. Adding to your existing position, right? If you can add to your existing, some other positions, okay, is when you decide to trade the neutral zone, which is not really easy, and it's something that happens quite rare. Remember, the middle line, the neutral zone, such as consolidation, there is a lack of or a lack of trend, so it's just bouncing. Do I have example over here? I have the live example. So if the asset is stuck within the middle Bollinger, so the one standard deviation, for example, that suggests consolidation. So even if you decide to trade it, it will be for just few minutes or even half an hour or an hour, if, for example, you are in 1 hour chart. So it's not so powerful anyway for ranging market. So there's no momentum, lack of trend, as I said, so it's not wise to trust the neutral zone. When you want to close a position, okay, as I said, okay, you might have your own exit strategies. That's fair enough. That's brilliant. Just keep in mind to keep here rule regarding the stop loss. I mean, to be 2 candles below or 2 candles above if you are in a downtrend. Or plus, when you want to close a position, you may apply the same techniques that you're using to confirm a breakout beyond or beyond the support or resistance level. You might use your technical indicators. Earlier I demonstrated the Fibonacci extension for spotting my targets, or even for spotting my potential target levels. Or you might use ATR. Remember, target 1, it could be the 1.5 ATR, target 2 could be twice the ATR, and so on and so forth. Not too tight though, not too high. If you're gonna use multi-target, make sure that you put for target 1 40-50% of your position, target 2 30% of your position, and target 3 the remaining 20% of your position. So split them wisely. What else? So don't forget to combine, right? Read the price action, what the body of the candles are telling you. Are they strong? Are they full body ones? Are they not? Are they weak? Are they doji? Use your Bollinger, and you can use also an additional one at the bottom, maybe an RSI or a MACD, up to you. Okay, up to you. Not more than 3, to be honest, otherwise it will get too messy. 1 to 3 candles closing in a new zone confirms that the move is real, right? Look at that. 1, 2 doji, 1, 2, 3 correction. So 1 or 2 3 closing in the new zone. In the new zone. Sorry, my bad. My bad. Yeah. So like that, in the new zone, within the zone. So 1, 2, 3. It's clear anyway. It's pointing higher and it has higher highs. Even if you see a bearish like this one, if you notice the high of this bearish and the low of this bearish candle is higher than the previous one, so that still is within the zone. It still have a higher low, so this is suggesting, even this pullback suggests that the trend upwards is real. Okay, you can also use moving average crossovers as well, even though I think it will get it too messy, but it's solely up to you. And I think that's pretty much it. So in sum, double Bollinger Band help us decide when we should be trading a trend, spotting and trading range, or refraining from trading. So it is, as she said, it is one of her favorite, actually it is her favorite strategy, okay? But that's solely up to the discretion of each one of you guys, up to you, up to your character. If you think that no, it's not useful for you, don't use it, okay? Just make sure that you use it only for trending markets and not ranging ones, okay? Yeah, and it's very, very, very useful for spotting entry points and stop loss levels. For targets, feel free to adjust, to apply your very own target, the way your let's say identify your targets, okay? Feel free. That's a bit more flexible strategy, useful for entry points, useful for stop loss. For regarding the target levels, feel free, okay? I think that's very straightforward. That was pretty much it. Simple as that, guys. Simple as that. It's for the very, very, very first time, or one of those rare times that I finish on time, right? So, any questions? There is a lot of free material, by the way, regarding these Kathy Lean's strategies, including this one. I mean, even if you type in Google double Bollinger Band strategy of Kathleen Lyons, you will find many examples, okay, and demonstrations. So because it's so straightforward, so simple, that many I have tried. So that's pretty much it, guys. If there are no questions, I'm gonna call it a date. Thank you very much for attending. If you have any questions, feel free to contact us at webinars@hfm.com, the email address that we're using with Michalis. Have a great day ahead. Take care, because it's inflation week. So there's a lot of cautiousness, a lot of indecision ahead of inflation. So that's definitely the spotlight of the week. So take care, okay? And see you again on Thursday with a live streaming in social media for the inflation, for the US inflation actually, and what the result of the inflation could mean for the Fed, for the next Fed meeting, for the US economy, for the next jobs report as well. So yeah, thank you very much. Have a great day ahead. Take care. See you again on Thursday. Bye-bye.